All right, guys, what's going on? I hope you're having a wonderful day. Happy New Year's. I think we might do a New Year's Eve stream tonight since we're all nerds and we're going to sit at home and smash our positive 2019 goals to smash options. We're not going to go out and get smashed, I hope, but enjoy yourself, be safe. I'm going to talk about this credit crisis and how it's affecting the market. I made a video on it the other day because some data, this market is just literally dried up with liquidity. It's affecting the markets and some other stuff I want to talk about with what we saw here today. But I'm going to go through, give you guys a homework assignment or really show you my investigation and my research to it. It's kind of, I called it the next big short. You guys are going to be little Michael Burries. I'm going to go through, this article is very recent. I'm going to recap some of that other video. I'm going to show you how to pick up the bond ratings on these CLOs and look through them and read them. We're going to go over the specific events of default, again, like the big short. And yeah, we're going to talk about it. But I will say this, I need your help. The fun fact is there's 1,500 of these. So there's 15 CLOs, 1,500. I usually get more than that in views on these videos. So if each of you did one, we could pretty much smash it. It's pretty difficult, so I'm gonna go through it, show you how to interpret it from what I know, or really skim through it, what to look for. And if you guys could find something important, I would love your feedback, because I saw from the comments on the last one, you guys have got just great comments. I loved it. So yeah, specifically the over collateralization ratios, I'm gonna need help with that, just with how they function here. So we're gonna talk about that, and yeah, get ready. I hope you guys, it's an interesting topic. Before I get into it, subscribe if you're new, or if, well, not, you don't have to, just if you want to learn more about stocks and you're interested in topics like this, and yeah, you're nice. Like the video if it's helpful. But let's get into it. CLOs, it's a hot investment for wealthy families. So these CLOs is the collateralized loan obligations. In the last video I discussed, it is literally the evil cousin of the CDO, the collateralized debt obligation of a mortgage. So the difference between the two, a collateralized loan obligation is they're buying loans. It's secured by a loan. A CDO, like the Big Short, it was houses. So people would give a mortgage, a bank would give a mortgage, and then whoever would issue that mortgage, they would sell it to a hedge fund or a family office or any investor who wanted a 3% or 7% floated return, which is, that's something with CLOs. It's the floating interest rate it offers. That's why people buy it. It offers a really, really high rate. And it's called, it was a CDO because it was backed by debt. It was collateralized by the debt of the house. Here is collateralized by a loan. So it's a little different. So what's going on with the CLO? Let's see, as it explains here. And you can see it's really grown recently since 2015 and 14. And this is my issue, is that as it's literally doubled almost since 2014, this is when we started seeing emerging market crises. And we saw what the market did without the effect of this credit market having a negative impact on liquidity or anything else. So now we're having emerging market crises. We're having oil go down, and now this is going up. But now it went from a hot market to literally December, it just dried up, and there was a lot of liquidity. And this has been a problem with some banks, that it has brought bank stocks down. They're having issues selling their loans. So this is the nature of banking and business. Pretty much, either the bank will give you a loan, right? You guys put your money into a bank. The bank takes your money and will give it to a loan for someone for a house or a business, and they collect the interest. That's how the bank makes money. And another way is they buy and sell debt. They'll buy debt from other people. They'll buy someone else who issued the loan, or they'll just issue a loan and sell it. So CLOs are typically assembled by managers, which buy loans that have been made to companies with sub-investment grade rating. So they find that would be a company that is sub-investment, meaning they already have a bunch of debt. The bond rating is bad. It's pretty much a high risk investment, and somebody made a loan to them, right? So somebody either gave them a bond or a loan, but now what you're doing is buying that loan. So somebody gave energy company $100,000 at 3%. So then these managers are buying that loan from whoever gave the loan. They'll say, hey, we'll pay you for the loan. You give us the loan. So now they own the right to collect the interest. So the managers then package the loans into a structure that could be divided into interest paying bonds and chunks of equity. So that's what they're selling. the CLO. They're giving interest payments and then whatever equity, or is sometimes that's how these deals work. I don't want to confuse you. The CLOs get debt and equity, but pretty much it's the riskiest and the most lucrative piece is what it says, because you're buying a bad loan from somebody and it's not secured by much, and you're really the last in line. And that's what they talked about. That's why the market has gone up so much, because recently they've rolled back loans to make it more difficult to get in on this, right? So the issue with these is pretty much these loans are funding bad businesses or stuff that wouldn't get good bond investments, and it's going to a huge market. This is literally non-banking financial services, where a bank will give a bunch of money to somebody then who it just wouldn't. It's really risky essentially. But it only gets risky if somebody's not going to buy the loan. That's the key. So now why are these guys buying these shitty loans? Because investors are willing to buy them. So they're buying all these bad loans that are yielding 10, 20%, packaging them all into one bond, and then they're creating it into this one bond product and selling that to an investment fund, a hedge fund, who wants a 10% on whatever money they put in. And they say that it's safe because it's so diversified. Again, this is just like the CDO. So I'm going to show you that now. So now you guys are up on the situation. Or well, maybe we could go, I think it was set it over here. You could say, I think there's only 1,500 of them. Yes, so for some, fast growth has recalled the subprime crisis, in which demand for high yielding credit fueled the creation of debt structures stuffed with low quality loans. So that's what this is. It's diversified, it's structured, but it's not high quality. Those in the industry say CLOs are different because the underlying loans to companies aren't as vulnerable to rising interest rates as subprime home borrowers were a decade ago. Among the 1,500 plus U.S. CLOs rated by S&P since 1994, only 36 tranches across 21 transactions had defaulted as of mid-2018. So very low, and they said the same thing happened. Similar arguments were made before the subprime debt collapse. With the historical resilience of mortgage debt, securitization is not alchemy. So pretty much it could happen, and that's what he's saying. Once defaults pick up, there's going to be losses, and that is the risk here. Is that one, investors, this is what I said, investors are leaving the market. That's it. The volatility panics people. This is even like the Great Depression, how a stock market caused a recession and depression. Investment dries up. It stops the investment demand. So people that's going to lead to more defaults. So what may be diverse now, it's not going to be. And that's where I said to the over collateralization, we're going to talk about this, but essentially if prices of debt or prices of assets drop dramatically, some of these debts could be, it's a lot worse than really what it is, and that could bring a default event. So that's what I want to say, because I'm going to show you guys now S&P. I went through this. I got to go through a few CLOs. I found them. It took me a while. So you guys, this is why you guys have to help me and show me some love on this, because I'm giving you this, but I need your help. I'm sure this is, this is crowdsourcing the stock market crash, but there's events of default. It's just like Michael Burry. He was looking at all of these offerings that they were giving, and he was seeing what they were holding. But at the end of the day, he figured out that by this date or this event, that once it reaches this point, it's going to lead to an immediate default of these bonds. And if there is a default in these bonds, that would further create a panic, investor loss, and that is what leads to the next panic and crash, which could happen here with the CLO market. So we want to go with the events of default, but let me show you how to get to it. So go to S&P ratings. You have to make an account. I made one already. Then go here, find a rating. Click it. It'll open up a new tab. And now here, you could search it, but browse ratings by practice. So I'm saying, you guys, please somebody play with it. I had to find it. I found it relatively quickly, but at the same time, it did take me some. I'm sure you might find a CLO hidden in between here. And so someone go look, but go structured finance and then structured credit. So now you'll start to see APCI CLO, AP CLO, all these different ones. And pretty much there's 842 total. That's what we need to go through. So again, there's more CLOs hidden around here, but you could start here. And I started with these guys. I looked, go read some of these articles, and I got one. I think it was like Ares Management or something. Yeah, see, like CLOs are typically somewhere like Carlyle and Ares Management. So what I did, I just wanted to find one of the biggest ones, right? I wanted to see, if these guys are one of the biggest ones, you want to see, because I looked at the first two. I pulled up one of them, like this one. It was like the first one, but it was only like 420 million euros, and it was European. But again, like, so here's the Aries, and look at how many they have. This is just that one Aries company. That is a lot. Then that's their European, So they have a lot, but I clicked one of them. So when you click one of them, it's going to take you to this page. And now, see, you got to log in. Yeah, I made a free account, pretty easy. So issue list, 7 million floating notes, and you're just going to get this. You click through them. It'll give you definite. It's not going to give you anything. That's the weird part, right? So what you have to do, just take the name, copy it, put it in Google. So Aries XXXVII, right? And then look for this XXXVII, same website, S&P rating, but wait for the one with the PDF. It's, again, so weird. Oh, here's I don't know if this is the more updated one, but this one's from 2015. So this one's a little out of date, and that's where we should see. But if someone, again, could find out how to pull up, this is all I need, but this is what we want to read and go through this. So this is what we're going to go. This is an offering now. So this is what they're doing. This is now, it's the pre-sale. So this is the pre-sale. Yeah. So this is the offering. They're saying, hey, this is what we're calling it. Here are the analysts, and this is the rating. So they're going over it and saying, this is what the company has offered. This is what we think about it. And then S&P gives its rating and discusses it, and they outline what is in it and everything. So you could see what's going on here, but what did I want to show you? So I think you guys should read it one by one as a story. So it explains what they're doing, right? Saying, as based on the collateral manager's decisions to manage this transaction and maintain this portfolio's collateral's original credit quality. This analysis generally reflects the application of our criteria to a combination of purchased collateral committed to be purchased, and the indicative portfolio of assets provided to us by the manager. It may also reflect our assumptions about the transaction's investment guidelines, the results, So this is the S&P rating. So they're saying, they're giving their rating, and they're explaining what this fund is holding in terms of collateral and equity, which, again, what is it all collateralized by? So this is what, 247 million of floating notes. 247, yeah. Interesting. Okay. Yeah, so let's see. Supplement test, transaction profile. So again, this is, you can see when it starts, when it matures. So this one's saying January 2027. But total note balance. So okay, so there's two. So they're adding to this. So they're adding 247 million. I think this is the remaining, but that doesn't add up to 247 million. So again, not fully on it, but it's telling you now the portfolio. It's a $400 million. Here are the main things that you need to know that I'm familiar with. Obligors. These is how many of those loans they're holding. So this is saying this is $400 million that you're buying. By buying into this Aries fund, investors are paying to get interest from 186 different people. That's what it is. This is a package of 186 loans. So the average is 0.5%. So this is good. The largest is 1%. These are all the factors, again, and it makes sense with the credit rating. These are big. The easiest way to look if something is a bad investment or not. How many people? If it's only with a couple people with a large amount of money, more risk it could fail. This is a lot of people, and then better, the average person is 0.5%, and there's nobody holding more than 1% of the total value. That's why it's so diversified. So again, though, the only way you really fail is if everybody fails, which is possible. So maximum weighted average maturity, 8 years, profile weighted average rating is a B. So again, weighted average, but this is a B credit, which is still pretty low, honestly. So they're giving the rationale, and they're going to say this is the rating. That's the thing you got to mix, because you're going to start seeing what the S&P thinks as well as what's coming from the portfolio manager. But all of this is written by the S&P. I'm trying to think if there's anything here I need to. Legal structure, no. So rating considerations. This is the stuff where, again, you guys go over, but what I'm really looking for in my thing, this is the thing I came to. I want to see who the loans are, and now this thing too, the obligor holding. That's all I care about. I want to know what debt is being held, what industry it is in, if there's anything being hidden. Like I found something with this one that's interesting. And then even more, I want to see the events of default, which is listed, which is saying S&P is telling you what it would take to default. And one of those things, I'm going to get there. I'll tell you now, though, it's related to my other video where I said the government shutdown, and even if we had a default, because if the government defaults, any default in the U.S. rating or other debt would impact these directly. That's what people don't realize. That's what I think is the big short, because even if nothing changed with this credit market, if there was a default on the US debt or a bigger default into another company like a GE, literally like a GE, which has already occurred, and then we see the issue with liquidity, if that occurs, it's related to the over collateralization, which I have not figured out 100%. But essentially, if they're not able to rebalance the collateral of their portfolio or sell off or redeem a certain amount of their portfolio, depending on how a rating change would affect their new outlook, then the fund would default, which means this 400 million would default by default, So, but this is what I'm saying for you guys. My assignment, I want you guys to see if anybody is weighted with too many loans to one person, one industry, or go read all these and tell me what you pick up from it, or see any events of default or something that could be an apparent risk to cause something. So this is a good one here, because you're saying what? You got 10 different things, senior secured notes. It's telling you the ratings, the credit, the outlook on all of these for them. But again, how much they're giving per obligor, and then how much they're holding per everything, right? But one thing I noticed here, and they have charts that'll explain it, but you see here, chemicals, 4%, 4%. This is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. That's only 80. Where's the other 20? Oh, no, 10. Yeah, that's still 80. I don't know. Maybe I can't count. No, it's only 40. You guys probably think I'm retarded. See, this is weird. That's what I'm saying. I'm not too familiar with these. But what I want to see, like even here with what it's bringing, this is for trading because industry shown in table 1. Oh, okay. So this is comparing everybody else, and is it comparing it to this one? I don't know. So someone figure that out for me. But so this is comparing this fund with the identified portfolio is us versus a target portfolio compared to the average of S&P ratings at 2015. So like this is one where I believe I'm reading this wrong. I thought I wasn't. I need to go back, but I don't know if this is, see, this is why I'm tripping, because I don't know if this is coming from S&P or the company, but this is the company. I initially interpreted this as being, they have a lot of business equipment and services, and they're listing it as different industries, where I'm thinking it's all the same thing. Business equipment services is a lot of the time related to energy and oil. And even then, I don't like those types of loans, but that's where you see here, the average for a portfolio, the target that S&P maintains is that business equipment services just below 15%. This one's above it. And that's what I'm saying. What you really need to look for is any of these funds showing a disproportionate amount of risk or overexposure to one industry, and then how big is that fund, and then what are the events of default and what could cause it, because now we're able to see dollar amount what could cause liquidity shocks, what could cause any issues here with the market. So again, and then it's saying, the diversification, the rating distribution, they have more B plus than the target, but they have, a lot of B. They have less Bs actually. So they're making it, they got more lower grade bonds actually, I think. Yeah, they don't, I guess a little bit more higher grade, but yeah, this one, I don't like this one. We'll see. Again, I need to go after this. So this one, the maturity, this is a shorter maturity, it seems like, but now the spread distribution, we don't go over that. Recovery rate, we won't go over that. Again, if I want you to, I don't want to go over this for the sake of the video, and I'm trying to make it for what you guys want to focus on. And again, I'm not too experienced with these ratings on, these types of investments related to it is similar, but this is why I don't even like bank filings. Because want to get it off the wrong foot, and then that could mess up my whole basis and my whole understanding. So if you guys know about it, you could add to it, or you guys could go through it and try to, but don't confuse yourself. What I'm trying to say is get to the part that could make that the problem and solution really, and that's why I'm focusing on where are these funds going to collapse is if there's overexposure, there's a loss of defaults, a systematic event that causes an automatic default, or just again in certain industries are these guys being tagged in it, and we're seeing why the spreads and the markets is going down. And somebody even said, I think Jason Fund said, I forgot to mention that the price of these become more expensive the fund as rates go up. That's why the market is crashing, but not necessarily because these are floating rate investments, so they benefit off of rates going up. So actually investors like to go into these when the rates go up because they're able to get even higher rates because it's floated. So that means what they'll return. So here's the guidelines that they give and what they're holding. And then this is the OC, the interest coverage and reinvestments. This caught my attention because it's mentioned in all of them. They have these requirements, and then how they have to it's related to when redemptions and the values of collaterals change. So they have to change it around and make sure this is the obligations and to keep their ratings. But I want someone to figure out this because this shows up on every one I looked at. Events of default, it comes in here. So this is what you want to look at. This is the Michael Burry saying under certain condition, the following events of default may result in the acceleration of payments to the preliminary rated notes and in the collateral's liquidation. So it's pretty much saying that if any of these happen, the fund has to close and they have to stop everything and pay back all debtors essentially. And then that pretty much means you're not getting your money back. So it's saying a failure to pay interest when due and payable to the notes, that's normal. Anytime a bond or any sort of investment like this that's supposed to pay out, if it fails to pay out, it triggers a default. That's what happened with VRX and their stock. A failure to pay principal, and well, theirs was a failure to their bond default in the event of not releasing a quarterly report. So in this case, if they don't pay interest, automatic default event. And that's the thing, even though there is events of default, once the default is occurred, they can negotiate out of a default, but it's still not good. The price of the asset, the quality, the structure, that's it. It's wrecked. It's like a totaled vehicle. A failure to pay principal on any rated note at its state of maturity or on a redemption date. So if they can't pay it back when they said they're going to give the money back. A failure to disperse amounts exceeding $25,000 from the payment according to the payment priority. Again, anything relating to not being able to pay back, that's it. This one I thought was interesting. The issuer, and someone let me know if this is standard, the co-issuer collateral pool is required to register as an investment company under the Investment Company Act in 1940. I saw this on a few and I didn't see it on some, but what makes me want to know is this normal where these are acting as essentially non-bank financial services, whereas if they had to register as an investment company, they would default. I want to know more on that. I think that's interesting. I want to know why that would affect the market so negatively and would cause, or why would force a default. So certain covenants under the legal documents, that's normal. But now this is the thing that caught my attention because everything else like involuntary bankruptcy, all these are normal. But the only thing I want to understand here is this over collateralization ratio. It's saying that if the over collateralization ratio falls below 102.5%, the event of default OC ratio is calculated without ratings-based haircuts, but includes defaulted assets carried at the lower of their recovery rate or market value. The trigger value, investing of voting rights for acceleration and liquidation are constant with the S&P CDO criteria. The use of rating-based haircuts, So it's saying if it falls below and then they recalculate it based on those, the throwaway the recovery rate and all that, but it's going to be, putting this into perspective, that caught my attention because what could that is related to, again, if there's a default elsewhere in the market, but now I want to understand what is the likelihood or what event or what would need to happen to their obligors or the debt for that exposure to show up where they realize the asset price, and that's really just asset price dropping. That means because then that's the collateral that it's backed by the loan or the collateral, whatever. But if they lose that asset, it's done. So that's where it got me, and that's what you guys are to do. But that's your job. I want you guys to go through all these. Maybe we'll come with questions with all these. I don't know what you guys think about this. It's confusing. It's long. I don't want to go too long into it, but hopefully you see where I'm getting at, where I want you to start. And I think if enough people keep going through these, we'll come across some stuff. And let's bring it all together and see what's unique, what's not to this situation and these types of assets, and go from there. But I'll leave it there. Long video. Show me some love, and I'm excited. Good luck.